All right, guys, let's go. Let's go. Let us go. Let us go. Good morning. Welcome. Friday, the 10th of July. The month is 10 days old already. Who would have thought? Welcome to the final weekly webinar of the trading week. Israel Keys Wealth Academy. I've been on my own this week a little bit. I'm looking forward to getting Talkback back next week. He's taking the week off for some personal reasons. Maybe I'll let him do next week on his own so I can chill. All right. Let's do this, folks. Let us do this. So, first of all, let's get rid of this so you can see my screen. And the webinar has started. So, this is what we're looking at the Mo. This is the chart of EU. Yesterday was an amazing trade. Find out exactly how we called it. Joshua got it. I did not. I hope the rest of you, or some of the rest of you, did get it. At this point in time, I am not taking a trade on this today any longer. I think it's done. All we could have asked it to do this week to be on the safe side. Any trade at this point would be one of those, oh, I need a trades. And those hardly ever work out. Let me see. If you ever jump into a trade because you just need a trade, bad idea. Very, very bad idea. So yeah, that's nick that as we thought it would. Into there. I'll show you right here. Into here. Manipulation block. This one right there. Yep. It's a thing of beauty when you know what you're looking for. If you dropped the 50% level on that order block there, that is to the pip. Look at that. That is what you call to the pip. Beautiful. What time of the day did it happen at? It happened at 9 a.m. in the morning. Yep, that's when it happened. 9 a.m. in the morning. It's 11 a.m. server time. That's 9 a.m. So 8 a.m. Actually 8 a.m. in the morning. And you get that beautiful reaction. If you had taken the trade, that would have been your entry. Actually, no, sorry. Your entry would have been here plus 2 pips. So that's it. That's 2. That's 5-4, 5-5, 5-6, maybe 3 pips to be on the safe side. 5-7. There would have been your entry. There would have been your exit. 1, 2, 3. Yep. And I think for Friday, that's no bad trade. So that's EU for the week. Of course, prior to that, this is Friday, Thursday, Wednesday, Tuesday. So it dropped down, then went up and took out that level that we wanted it to. We wanted to see that level taken out. It did. It waited till Thursday, took its sweet time into this order block right here. That was the order block. And in fact, it didn't just take out that level, it took out this one too. MetaTrader started again. Don't start with me this morning. I am not in the mood. Morning, guys. Morning, Gerard. Morning, Natalia. We have a 4-hour reaction. Tells us it's a live trade. It comes back up. So 4-hour reaction here. Comes back up. Actually, this is the first time you would have taken it. This would have been the first where you would have taken your Fibonacci. Pretty much near 61.8. And then comes back down. If you missed it on the way down, I showed you all this last night. This here would have been your re-entry. Beautiful trade. Right. That's EU. Let's look at Swissy. What does Swissy do this week? It started the week. We knew it had its eyes on that. Going into there. That's a daily order block. This here is the daily order block. Let me show you a little bit more. This one here. That's the order block. So it comes in, nicks that just there. I wouldn't, well, I didn't anyway, but even if I wanted to, I wouldn't have traded Swissy this week because I don't think it gave value for money based on some of the other trades until yesterday. But at the same time, it was giving value yesterday, but EU and GU were flying as well. But coming down into the block here, this is an example. For those of you that I've been talking to about the one-day engulfing, this is an example of a one-day engulfing right here. This day here. Price starts out there, right? Takes out a previous day's high and then comes back and takes out its own low. On a daily chart, this is what it looks like. See that this candle here? It goes out, takes out that candle, comes back down, closes. Well, it doesn't close below the opening, but it takes out its opening. That here is a sign that the next day is good for a short. So this was Friday, Thursday, Wednesday, Tuesday. So this was Tuesday. Fibonacci. Right, so this came back to 50. We didn't get 61.8. So, yeah, we probably wouldn't have taken it. But still, yeah, we probably wouldn't have taken it. Also, let's see, 50-minute chart. Is there anything we could have seen on the 50-minute chart? Because based off the 1-hour chart alone, I would not have taken that trade. It was a good trade. I just wouldn't have taken it. Me personally, I would not have taken it. Now, in hindsight, this is one of those hindsight ones you can see there. That's a manipulation block there. But it doesn't even reach the manipulation block. So, yeah, I would not have taken this trade. I would not have taken it. Personally, it was a good trade. I just would not have taken it. So, you need to be comfortable not taking some good trades. Some trades are great. You just don't take every single trade you see. However, this here was the good trade. Price drops back down into that level here. What level? This one takes out that low there and then gives an engulfing to the upside. So 4-hour engulfing, bang, drop back down. It comes back down into that level. This is textbook actually. So yeah, this is a trade that probably should have been taken yesterday. Definitely should have been taken yesterday. And it gave several opportunities to do so. If you refine it down to a 15-minute chart, there you go. On a 15-minute chart, there is the order block there. So he did this in London. It did this in London. Give a market structure break in London. And came back down here in New York. And it did its best to give you an entry. It was begging to be entered. 1, 2, 3. And the third time it said, if you haven't gotten on board by now, you're not interested. If you put your entry there, your stop loss there. Whew, that's an 8 pip trade. Lord have mercy. This is the kind of stuff that gets me excited. That is an 8 pip. Look at that. 7.5 pip stop loss. 1, 2, 3, 4, 5, 6, 7. And of course, where would you have been wanting to get out? Back here. Here. There we go. And in fact, me personally, I wouldn't have waited for there. I would have been out down here. So I would have been, the moment I saw this reaction here, I would have been out there. And as you can see, that's the exact same level. The exact place that I would have been out is the exact same level you see the 15-minute market structure break. Well, this is 30 minutes. Market structure break the other way. And so even if I didn't get out here and I rode this through, I would have definitely gotten out there. And then by the time you see this formation here, guys, this is a sign. Good morning, Esther. This is a sign that this trade is making up its mind what to do. Let me help you guys out, right? Do not be in a trade that it's making up its mind what to do. Even if it eventually goes in your way, it's still bad business. You enter trades that have shown you the elephant is running through your garden. Gerard, remember that? You wait for the elephant's footprints and then you follow it. Don't wait for it to make up its mind. Don't be in a trade with the elephant while it's deciding what it wants to do. And so this could go either way. It's being rejected here, but it keeps coming down, though it's being rejected here. It's being rejected up here, but it keeps, so this could bounce back up. It could drop like a stone. I'm not interested in finding out. So if you got in here and you rode it all the way up there, yeah, that's 40 pips. You could say that's not much, but still, if you bear in mind that you're working with a 7.5 pip stop loss. Let's call it 8 pips, right? Let's call it an 8 pip stop loss. Although it's 7.5 pips. That's still 1, 2, 3, 4, 5. That's still 5 to 1. You're good. That's a good week. That is a good week. Don't let anybody tell you otherwise. Any of the cowboys on Instagram. If all you take is one trade a week and it gives you 5 to 1, you are on your way to becoming a professional trader. Let's see, what did GU do before we go into teaching? Yeah, GU was the one that got away this week. Ooh, GU. Yep. GU was a bad boy this week. So Friday, Thursday, Wednesday, Tuesday, Monday. So it opened up the week with a consolidation. I think I showed this to you yesterday, but I'll do it again. So it opened up the week with a consolidation across 2 days, Monday and Friday. Right? So consolidation across Monday and Friday. On Tuesday, it formed the low of the week into this order block right here. Now, even if now, yesterday I showed you how to do the top-down analysis all the way from the weekly down to the 15 minutes in my case. I'm not going to bother with that today. But even if you didn't do any of that, the moment you see this happen, so it, first of all, as at last week, that was the expansion. Always do it from high to low. That was the expansion. I keep doing these analyses, micro-analysis, every time we have a teaching session because I'm trying to get you in that groove, right? I'm trying to get you in the groove. So that was the expansion. Now, it didn't come down to 61.8, so we wouldn't have trusted it here. However, once it does this, okay, fine. So we tip our hands to it. It takes out this high here and also that high here. So this is the one, the day high takes out. The first day's high it takes out. We're going to put that in green, because that's a daily high. Get rid of the Fibonacci there. At which point this is now a valid micro expansion. It comes down into the 38.2 to 21.4 level, the sweet spot there, right? And then it takes that out. It also takes this high out here. So we are now hunting the next expansion, which would have been from there. So even if you missed Tuesday, this is how it works. The elephant showed you what it was doing on Tuesday. So you could have gotten into Tuesday, but even if you missed it, because the elephant has shown you what it's doing, you just wait for it on Wednesday. On Wednesday, it comes back down to 38.2. Look at that there, right? It's inside there, right? And what is it inside when it gets there? So that's, okay, I'll leave that there, 38.2. What is it inside when it gets in there? It's inside the old order block from there. But to really show you where it is, two things. One, this here, this there. One second, this here is a manipulation block, right? That's a manipulation block all the way up to that there. Why? It looked like a bearish order block, price reversed and blew through it. It hasn't come back to touch it yet. When it comes back on the downside, you wait for a reaction. If you get it there. Also, this is a fair value gap. It's a 1 hour chart, so we're going to make that blue. It's a fair value gap there, blue. Let's get rid of the Fibonacci. It's making the place look a bit clustered. And you see that reaction on 1 hour chart. On a 15-minute chart, you would have gotten a quicker reaction on a 15-minute chart. So that would have been your entry. This would have been your entry. Let me see. Your entry would have been here. Your stop loss would have been there. 1, 2, 3, 4, 5, 6, 7, 8. So all the way 1, 2, 3, 4, 5, 6, 7, 8 before I start to come down. However, I probably wouldn't have taken this entry here because I wanted to be safe. However, once this happens and comes back there and it bounces up again, this then becomes a second chance to enter there. 1, 2, 3, 4, 5, 6, 7. Doesn't quite get to 8 that time. Or you could have just put this back here and just put this again there as your second entry. 1, 2, 3, 4, 5, 6. 6 to 1 is still very, very good. And then today, Yesterday was another example of a 1 minute, of a 1 day reversal here. It's a 1 day reversal. Why? Price comes up here into that order block and then takes out that low of that day. Put that in green because that's a daily low. Now, this is the one where I could still get a trade in GU today. I want to see how it goes. But there is a possibility of a short in GU today. I'd be very, very, very careful about taking it. But there is a possibility. Why? Price reacted. Actually, it didn't react to that. It nicked it. So, okay, so that's good. So it actually took out that order block there. That's blue. Took out that order block there. Right? And where, okay, that's where it came to. So again, this is one of those ones where you need some experience to see this. This is a manipulation block right there. If you drop down, you probably see it on a 15-minute chart. There it is on a 15-minute chart. Price comes up. It looks like it's a bearish order block, and then it blows through it. It blows through it, and it hasn't come back to it. It came back here. So I did think about taking this trade today. Let me show you. I wanted to, but since it's the opposite direction from the trade I had planned to take this week. So you could have entered here. That could have been your stop loss. Or you could have entered here with a tighter stop loss. Either way, I would still only be up 2%. So I'm not sure what price wants to do here. That's why I decided against it. I'm not sure what price wants to do there. Now, there is Fibonacci range from here to here. If price gets above that, into this range here, into the high premium, say, I'll give an example of a level it could respect. There is a manipulation block down there. If I get this at or before New York, which starts in 30 minutes, so let's say anytime between 12 and 1, 2, it has to be early. By the time it starts getting to 4, 3, by 3 anyway, I'm out. By 3, I'm done for the week. I'm like, let's forget about it. If I see that, then I'm good. Now, it's already at 50. It could just do this. It could just be that this is what sends it down. So if I see a 1 hour, basically I'm looking for a 1 hour engulfing in any of those two zones, and I might take the trade. Emphasis on might. But I am of the mind just to say it's been a good week of analysis. Missed my 2 entries. Wait for next week. It happens. The reason why I want to see this one taken out is it's intermediate liquidity. So I would trust the higher one a bit more. Anyway, those are the 3 pairs on our watch list. So let's carry on with our teaching. Let's finish talking about, yeah, that's Reggie's time frame, Reggie's strategy. Right, so one quick second. We've done a whole lot of teaching this week, guys. Some really, really good stuff. I would really advise that you go back and watch the videos again. You are getting gold for the price of wood. It's only in the next few years, as you guys become better and better, more experienced traders, that some of you will really begin to appreciate the value of the things that you are being taught, in some cases, right at the beginning of your journey. Right. Where are we? So yesterday we started looking at multi-time frame analysis. Trying to find the right chart I was teaching on. Where are you? Definitely wasn't that one with all the levels. Where are you, teaching chart? One quick second, guys. Trying to find the chart that I took yesterday's notes on. Right. No, this is not yesterday's notes. This is from earlier on. These are all stuff we taught over the last 10 days. As you can, if those of you who are just coming on for the first time, we've really done a deep dive in recent times. Right. Okay. I will find it. Just give me a quick second. It's definitely not UCAD. It's not the dollar index. Not this one. Is it? Nope. Nope. All right. I guess I'll just start a brand new chart and start typing again. Which is annoying. No. I remember. Yes, this one. Yep, that's the one. Found it. So, for those of you just coming in, we've just done some brief end of week analysis. Go through the video again. We've looked at the 3 pairs on our watch list. So, multi-trade analysis. Let me put this up there. Right, text. Multi-time frame analysis. So this is what we looked at yesterday. You ask yourself, what's the max length of time you want to be in a trade for? What time frame is your natural favorite? How often are you able to check your charts? From these questions, you determine your reference time frame. Then you pick 2 time frames above and 2 time frames beneath. So you're working with 5 time frames. You can get away with 4, but I like to do 5. Your highest time frame is your big picture time frame. That's what you're looking for it on there. It's on the screen. Let me see if I blow this up just a little bit. Nope, that ain't gonna work. Then your bias time frame. 1 second. So yeah, opens highs, closing lows in your big picture time frame, swings highs, lows, and liquidity profiles on your bias time frame. Your reference time frame, you find discount, premium, expansions, retracements, highs, lows, and liquidity profiles. On your signal time frame, you get your entry signals. And on your entry/management time frame, the lowest one, you get refined entry and exit and your risk management ranges. In essence, your stop losses, your take profits. So now I want to take it a step further today. I was going to do this next week, but I thought great to just tag on from yesterday's class. I want to look at the specific characteristics that you might want to be aware of in each particular time frame. So in essence, whichever time frame is your reference, bias, signal, entry, all that stuff, some specific things that are peculiar or important to understand or think about in each time frame. So let me find a new chart. So 1 second. This is the one so we're going to put this at the beginning. So we know that's the one. And then we'll also put this here at the beginning too. Cool. So now I'm going to skip the monthly for today for a reason. Unless you're a swing trader and above, this really is not a time frame that you need too much to worry about. I will do a specific different video on a monthly chart when you get to the intermediate phase of your training. So for today, I'm just going to skip the monthly. It's not that it's not important, but to get you guys started, I'm going to skip it. Now, on a weekly chart, and I'm not going to make too many notes today, so you might want to make the notes yourself. Sorry, I just spilled some tea all over my workstation. And it was good tea too. Give me a quick second, guys. I just need to clean this mess up. I won't be more than 30 seconds. My workstation has some books on it, so I don't want them to get soiled. Right. So, on a weekly chart, first of all, you need to know that every divider is a year. Every divider is a year on a weekly chart. That's the first thing you need to know. So write that down. On a weekly chart, every divider is a year. You know what? Why not? I'll just write it for you, because I'm nice like that. So weekly text properties. Weekly so number one, every divider is a year. Why is that important? Well, the same way we use the daily and the 4-hour charts, as you can see here, at the start and the end. Now, sometimes there's some huge exceptions. For instance, this particular year here, 2018 coming 2019, there was a huge move here. But by and large, you can almost skip the starts and ends of the year. The last week of one year, the first week of the next year, you're not going to see much of a movement. So that's why I usually take December and January off as a trader almost every year. I take the last 3 weeks of December and the first 3 weeks of January off. This is why. Now, that's the first thing you need to know. The second thing you need to know about a weekly chart is, most of the time, weekly charts will range. I've done that again. 1 second. Okay, so number one, every divider is a year. Number two, weekly charts often range. And by range, we mean consolidations. So it is very, very, very often to see this on a weekly chart. I'll give you a couple of examples. That's a nice consolidation area there. That's another one there. That's another one. Let me see. There's one roughly there. So you see that this happens fairly often. But that consolidation is a whole 171 pips. So you have 171 pips this way, then it bounces that way, then it bounces that way. So if you miss this and you miss this, you can get this. The often range. Go look at the video on trading in consolidations for how to handle consolidation market conditions. But on a weekly chart, if you see this on a weekly chart, that's a classic stop hunt on a market structure break, right? Classic stop hunt, market structure break, Fibonacci retracement, deep discount, right? And an engulfing. I want you to look at how far price travels from that signal. That's the same kind of signal we would take on a 4-hour chart. When you see how far price travels from that point, 724 pips. And so, let's put this there. Weekly market structure is gold. It's very rare, well, not very rare, but it's not too often that a weekly chart gives you clear, what have I done again? A weekly chart gives you clear market structure. But when it does, you can trust it. Weekly charts. Often range. When a weekly chart gives you clear market structure, you can trust it. And it is likely to stay in that direction for a significant amount of time. The problem is weekly signals take a long time to mature. Take a long time to mature. And finally, price can retrace for several days / weeks and hundreds of pips. That's days / weeks, and let's make this hundreds of pips. So, for instance, from this point here, the weekly bias is short, right? So we have 1, 2, 3, 4 weeks short, an up week, a down week, and then here, look at this. This here is 2 whole weeks for 200 pips where price is going the other way. If you're working off weekly signals, can you be patient for this 2 weeks to either come out here on the engulfing and wait for the other way, or sit through? Can you imagine sitting through 200 pips of drawdown? Price is going against you for 200 pips. How many of you would have gotten out and said, I can't handle this anymore? But then if you'd waited, it would have given you an extra 450 pips. So price can retrace for several days and several hundreds of pips. your stop loss will be huge. So you need a fairly large account, because factoring in the leverage, for instance, if you trade in the UK, they reduced our leverage on most accounts now to 30-1. Stop loss 30-1. Put this here. That there. That there. That there. All right, cool. So, for instance, let's blow this up a bit. On the weekly chart, this here would be the fair value gap. So this is a fair value gap on the weekly chart, right? That line there. From when price leaves there, 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks, 8 weeks, 9 weeks, 10 weeks, 11 weeks, 12 weeks, 13 weeks, 14, 15 weeks. That is over 3 months for this trade to set up. Look at that. Can you wait 3 months for a trade to set up? For the vast majority of you, the answer is no. Therefore, you cannot trade the weekly chart. Therefore, you cannot be a position trader. However, I'm just going to stay on this one here. I'm going to stay on this setting here. However, most market makers use this as their reference chart. I need you to remember that. Most market makers, not all of them, but most of them, the major hedge funds, the billion-dollar hedge funds, the investment banks, this is their reference chart. All the stuff we're doing on a 4-hour chart, they're doing here. Now, I want you to think about that for a second. Let's drop down. Think about that for a second, right? Their stop hunts, their fair value gaps, their order blocks, their retracements, their discount and premium. The market maker, more often than not, is using a weekly chart to arrive at that. If you know that, let me just take this so far. If you know that, even if you are not using this as your reference chart, you definitely need to keep an eye on what it's doing. Because the elephant you're trying to track through your garden, this is the elephant's roadmap. Think of the weekly chart as the elephant's sat nav. Type in the comment section if you understand what I mean. That elephant's sat nav is more often than not your weekly chart. Some will use a monthly, very few will use a daily. This is how they are planning their long-term price objectives, their long-term premium and discount calculations. They're using this chart right there. All right, so in essence, also, if you drop down to a 4-hour chart, we'll show you this in a second. We teach you on a 4-hour chart to look for weekly highs and lows, right? They're gold. That's one there. That's a weekly low. That was the trigger for that move. This here is a weekly high. In fact, it's the weekly, well, it's the weekly high of this week here. And it was the trigger for this move. So on the 4-hour chart, each divider is a week, meaning each divider is a weekly candle, right? If weekly highs and lows, there's a weekly low there. Which was significant one way, it's now significant the other. This might drop here. If weekly highs and lows are significant on a 4-hour chart, well, on a weekly chart, each 4-hour weekly divider is a candle on a weekly chart. This is why if you are anything from a swing trader and below, you're not a position trader, but even if you are a position trader, this is why the open, high, low, and close. I'm going to show you that next week. We're going to do with candlesticks next week. It's going to be the bomb. Most people start teaching with candlesticks. I haven't intentionally. I don't want you to get so focused on the stick and miss the bigger picture of price action. But now that we looked at the bigger picture of institutional order flow, we're going to look at what candlesticks are and how they work next week. But we have something called the open, high, low, and close. OHLC, open, high, low, close. This is Candlestick 101. I'm going to break that down for you next week in a lot of detail. But for today, just think of it this way. Look at this candle here for a second. Let's take this one. This candle here. The white candle in that range there. That one. This white candle here. It opens up here. In essence, if it opened up there, then one or two things happened. Sometimes it opens at the close of the previous candle, but it didn't. You see, there's a gap from that open, from that close to that open. And that gap there is how many pips? That's a 46 pip, 45 pip gap. Why did it gap down that much? Secondly, and I'll tell you one of the reasons why we see gaps in price. Because when the market's close to us retail traders, they don't close overall. You can't trade from Friday night to Sunday night. Some entities can. There's overnight trading going on at some levels. Huge market maker levels, right? Also, events are happening. Data is being analyzed. Things are going on in the real world and the financial markets that change the price of that asset. So in that weekend, while you are locked out of the market, the price is moving. If it gapped down here, it means, especially in the weekly chart, if you see a huge gap on the weekly chart, something significant happened that said this was the place to start from. So it could have been going down over the week. It could have even gone past down there, but it won't print on the chart, and something drove it back here. In essence, the open, whatever reason it opens there, either because it's the close of the last candle or there's a gap, that there is a significant level. If the week opens up there, it means whatever happened over the weekend, that opening price was a significant level. Something refused to let it move beyond that price, but also something drew it to that price. That's extremely important. Of course, whatever the low of the week is a sign that there was long-term liquidity resting at that level in the past? Let's see. Bingo. There we go. If we drop down even further, there we go. See this line there? So for whatever reason, it's significant, right? All right. And then we have the high. That's obvious. Something, it went up, either something that liquidity attracted it, and or when it got there was significant enough liquidity in the opposite direction to stop the move. Again, let's look back in the, there we go. See that there? There we go. See that there? See that there? And finally, let's get rid of these. Whatever level it closes at that week is also a significant level, because that was where the market makers felt. See here, it comes back down and it closes there. It refused to go past there that week. Before the market makers decided the week was over, they felt that was in essence, they're telling you that's their understanding of the fair value of price to end that week. Open, high, low, and close on a weekly chart is gold, because the market maker is telling you, he's giving you 4 significant price points. That elephant is telling you these are the boundaries, the 4 walls of this period of time. Look, going into the future, look at this. That is respected there. The very next week, you see this respected, 2 weeks from now, this respected, that respected, right? If we come back down here, I will bet you lunch one day that we're going to see that respected as well. Because a week in a market maker's mentality, like I said, this is their reference chart. So where that week opens, closes, the high it forms and the low it forms are golden. Drop down to a 4-hour chart and you see it clearly. Look at that. One second, let me see, what lines do we have there? So I'm going to take this away, and this away, and this away too. So we're dealing with the open. So the open down here, the high, the low, and the close. On a 4-hour chart, so look at the one second. Look at the respect levels. See that there. I'll take that away because this is the week we're looking at here. Look at that. There. Look at that. There. Look at this here. Look at this here. Look at that there. Let me know if you can see it. So unless you are a position trader, for the vast majority of you, to simplify the weekly chart, what you really want to be looking for in a weekly chart, to give it to you in chewed format. Actually, I just carry this on. You want open, high, low, close, 1. You want My brain's just locked for a second. And you want now the particular liquidity profiles you want. Of course, you've done your open, high, low, close. You want gaps and order blocks. You can almost forget about the other kinds of liquidity profiles because you will see them on a daily chart. And by gaps, I mean both momentum gaps and fair value gaps. Open, high, low, close, gaps, and order blocks. Finally, actually, let me see. That doesn't need to be that big, actually. That can be smaller. We need space for one more. All right, let's see. Get space for one more. All right. Okay. The dividers here. Weekly charts of a rain. We're trying to go. Weekly is going to take a long time to mature. Price can be changed for several. Surpluses will be huge. So in the fair large account, most market makers use this reference chart. You want, let me rephrase that. Look for weekly open, high, low, close, gaps, and order blocks. Right. Something just jumped straight out my mind. There was something I was about to throw in there. I just forgotten. One second. Let me just look through this again. What am I missing? I'm missing one more. Okay. Ah, yeah. Number 9. Do not, as a retail trader, use weekly indicators. Don't. Absolutely do not. One second. I deleted my number 8 now. What was my number 8? Snap. What was my number 8? Okay, yeah, I remember what my number 8 was. Do not use weekly indicators. Let's put number 8 back. 8. Look for weekly open, high, low, close, gaps, and order blocks. Do not use weekly indicators because they're useless. I'm giving you an example of what I mean by useless. If I stick on here, shape. If I stick on a rectangle, no, not that. Indicators, customs. So let's assume that I wanted to use I don't know. Let me use a Bollinger Band. Let me use from Ready Signal Bollinger Band. Now, at the top of this band here, by the time price gets here, for example, right? Look at how many weeks it takes for it to move. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 before it starts to move. But it's touched the top of the band here. Because unless you're a position trader, in which case you're waiting that long, the fact that a weekly indicator is overbought or oversold or whatever means nothing if you're trading, intra-week. Because it could stay oversold for weeks, maybe even months, or overbought. So don't use weekly indicators. unless you are a position trader. Let the weekly chart simply tell you, okay, I'm going to show you that in a second. Delete. So anyway, don't use weekly indicators. Yeah. So what should you use a weekly chart for? Let's put that there. Use weekly, or let me just put use W1 for now. I'm working with the assumption that none of you are position traders. However, just in case there is one position trader watching this now or in the future, use the weekly chart for one. Reference time frame for position traders. Two, use it for to determine macro trends. In essence, you want to know if you are in a fairly long-term trend. Having macro trend, in which case you know that you can hold a trade over an entire week or several weeks, at least 2 or 3 weeks if you want. Number 3, to anticipate daily, let's put D1, engulfings and 4-hour stop hunts. Actually, let me add that. So key levels and then to anticipate. So you can pretty much anticipate where your daily engulfings and 4-hour stop hunts will form by looking at a weekly chart. So for the way the vast majority of you trade, oh yeah, 1 second. And to measure long-term profit objectives. In essence, I've done that again. I've done it again. Right, so let's write that out. That was a long one. 3 key levels to anticipate D1 engulfings and 4-hour stop hunts. So when you are looking at your 4-hour and your 1-hour chart, your open, high, lows, and closes from your weekly chart, your key levels from your weekly chart will, I remember. This is what I was trying to remember. All the blocks. Actually, no. It's fine. Just leave that there. Leave that there. Right? Measure long-term profit objectives. So if you're anything from a swing trader downwards, that's what you're using your 4-hour chart for. And 5, your directional bias for a swing trader. for swing traders. So if you're a swing trader, only ever trade in the direction of the weekly chart. I cannot say that enough. If you are a swing trader, only ever trade in the direction of a weekly chart. Let me say this one more time for those in the back. If you are a swing trader, do not attempt to trade against the direction of the weekly chart. One more time. If you are a swing trader, new students, you'll find that out next week. If you are a swing trader, do not attempt to trade against the directional bias of a weekly chart. You will get burnt. I guarantee you. It's even worse than an intra-week trader trading against the daily bias. It's worse because the signals are far more reliable, positively and negatively. The higher up in time frames you go, the more, like I said, weekly market structure is gold. The higher up in time frames you go, the more significant directional bias becomes. Do not do it. Don't rush for a quick trade. It's not going to be worth it most of the time. So that's the weekly chart. I'm going to stop with the teaching session of today's session for today. I know it's a lot to take in. We'll do daily next week. Any questions so far? I've left plenty of time for questions today, and if there isn't that many questions, we can go and look at some charts to see what we can expect for next week. So any questions? Let me see what this is doing while we're waiting for the questions. Any questions? Aha, that GU is looking promising. But I still don't think I'm going to take a trade this week anymore. Questions? While I'm waiting to hear about any questions, this is your assignment over the weekend from today's teaching. On the 3 pairs we're currently tracking on our watch list, EU, GU, and UCHF, I want you to go to your weekly chart and I want you to mark out the open, highs, lows, and close. Open, highs, lows, and closes for every weekly candle within 200 pips of current price range. So for instance, using this chart here, when Friday closes, if it closed where it is right now, 200 pips above would be there. So I'll use that candle there. So that will be the top range. And then the bottom range, 200 candles, would be from here, 200 pips, sorry. So this candle there, so there. And you should be doing this every single week. So this candle, this candle, this candle, this candle, this candle, this, anything in between here and low, any candle that has a high, and so for instance, this here, for this black candle here, we would put the low, we would also put the close, but we would not bother with the open and the high because it's above that range there. Does that make sense? And of course, if you see, for instance, this candle's low and this candle's low are the same line, you don't need to draw them twice. So do the open, high, low, and close for every candle in between a 200 pip range of where price is at the moment, and draw them out for next week. Do that over the weekend. And then see how price respects them as the week unfolds. All right, no questions. Cool. So let's look at the chart one more time before we dismiss. So there is still a potential trade on GU that may be setting up. Swissy. Nah, I wouldn't touch it. Nah, unless it does something real clear. Like, yeah. And EU, I think EU is done for the week in terms of real high quality trades. Yeah. It'd have to get back up there for me to take a short. If it were to reverse, let me see now. If it were to come, say it shorted from there, if it were to come back into that range there, here into this order block, would I take a long to get there? Nah. So other than GU, I wouldn't advise potentially that you took any, but let's see what New York does. But I personally, I'm done for the week. All right, guys. So you got plenty of homework. For those of you, if you've missed any of the sessions this week, please go through the WhatsApp groups. In Telegram, I'm going to post the sessions in linear order for you to follow through them. I'm also dropping, for those of you who paid, in the next hour, you get your second tranche of PDFs and recorded videos for the Market Breakers course. Take care. Have a great weekend in the markets. Look forward to seeing you on Monday at 9:15 for our pre-week review. All right, guys. Take care. Have a great week.